Hello everyone, welcome back to the Wright Research channel. Let me start with a number that should make you uncomfortable. South Korea's KOSPI index gained roughly 116% in 2026, peaking above 9,000 points on June 22nd. Then, in about 5 weeks, it gave back close to a third of that. Circuit breakers, the automatic trading halls, were triggered again and again through July. On July 13th, the index fell 8.95% in a single session. On July 28th, it fell another 10.84%. On July 29th, it dropped nearly 13% intraday, before closing down about 6%. Here's the part that makes no sense at first glance. Samsung and SK Hynix did not collapse. SK Hynix posted profits that jumped almost sixfold from a year ago. The companies at the center of this crash were making more money than ever. So, what wipes out a third of a national index when its biggest companies are printing record profits? That's today's video. And I promise you, this is not a Korea story. This is an India story wearing a Korean costume. Let's get into it. So, how did Korea get here? In our last video on Going Global, we flagged that the KOSPI had already started correcting while Japan was running. At the time, it was a footnote. It is not a footnote anymore. South Korea became the epicenter of the global AI hardware boom. Memory chips, the physical picks and shovels of the AI build-out. And Korea won that trade decisively. But that success was dangerously narrow. Just two companies, Samsung Electronics and SK Hynix, grew to roughly half of the entire index. Think about that. Half of a G20 country's benchmark, riding on one semiconductor cycle. Compare that to your Nifty 50. IT is under a tenth of the index. The rest is spread across financials, energy, FMCG, autos, pharma. When one sector catches a cold in India, the other sectors keep the patient standing. In Korea, there was no other sector. And the real fuel was leverage. That is, concentration risk. It is not a theory. It is what half an index means when the cycle turns. Concentration alone doesn't produce a 30% crash in 5 weeks. Concentration plus borrowed money does. Korean retail investors had borrowed aggressively to chase the AI rally. Margin loans hit a record of about 38.6 trillion won in late June. Total investor debt in the market had crossed 60 trillion won by the end of May. And then there was the accelerant. Single stock leveraged ETFs. Products designed to multiply the daily move of one stock, usually by 2 times. Great on the way up, mathematically brutal on the way down, because these funds rebalance daily and are forced to sell into falling markets. This is important, so let me be clear about what leverage actually does. Leverage does not just make you lose faster. It takes away your right to decide when to sell. The margin cascade. Let's explain this simply. Here's the loop. Learn it once and you will recognize it for the rest of your investing life. You borrow from your broker to buy shares. Those shares are the collateral. Price dips, collateral value falls. The broker issues a margin call demanding cash immediately. You can't produce the cash. So the broker sells your shares for you. That's not a threat, that's the contract you signed. That forced selling pushes the price down further, which triggers the next investor's margin call, which triggers more forced selling. No human is deciding anything at this point. It is automated. It is self-reinforcing. And it does not stop when valuations get attractive. It stops when the leverage is exhausted. A normal correction became a crash because the system ran out of cash, not because the companies ran out of profits. So, what lit the match to KOSPI? 3 sparks roughly at once. 1. On July 16th, the Bank of Korea raised rates by 25 basis points to 2.75%, its first hike since January 2023, citing inflation, household debt, and property prices. Overnight, holding leveraged positions got more expensive. 2. Sentiment on the AI trade cracked. Worries about excessive infrastructure capex and fears that cheaper Chinese memory chips would erode Korea's dominance. 3. Earnings met reality. SK Hynix grew profit nearly sixfold, and the stock still fell hard because expectations had been priced for a future where nothing ever goes wrong. That last one deserves its own line because it is the single most misunderstood thing in investing. Share prices do not move on whether the news is good. They move on whether the news is better or worse than what was already assumed. A stock priced for perfection has nowhere to go but down, even on excellent results. What is the billion-dollar casualty? If you want to see what leverage does to someone genuinely intelligent, look at what happened to Situational Awareness LP. This is the fund founded by Leopold Aschenbrenner, the former OpenAI researcher whose 2024 essay argued that AI progress would demand an enormous physical build-out of chips, data centers, and power. That thesis moved billions of dollars of allocation across Wall Street. And the thesis worked. Through the first half of 2026, the fund reportedly returned 439% net, according to an investor letter reviewed by the Financial Times. It was, on paper, the best performing large fund in the world. Then July happened. The fund ran leverage reported at up to 4 times. When AI infrastructure stocks corrected sharply, its prime brokers, Goldman Sachs, JP Morgan, and Bank of America, issued margin calls. On July 30th, the entire public equity book, longs and shorts, was sold in a single block to Ken Griffin Citadel at a discount. Now, an important correction to what you may have heard. The fund did not vanish. Reports suggest assets fell from roughly $45 billion to around $10 billion, and it continues as a private investment vehicle, retaining a large private stake. The public book was liquidated. The firm was not erased. But the lesson stands, and it's a humbling one. He may still turn out to be right about AI. His research was not the problem. His timing and his debt were. Foresight is worthless if you don't have the capital to survive the volatility that arrives before you're proven right. Leverage does not care how smart you are.
That
Now,
a
the
market
question
crash
that actually
driven by this
matters,
exact
can this
mechanic
happen
is his
here?
biggest nightmare.
This is not a
The
hypothetical
concern
for
isn't
us.
about the Korean
Nithin
economy
Kamath,
alone.
the
It's
CEO
that the
of
hidden
Zerodha,
mathematical
India's
traps that
largest
broke the
brokerage, watched Seoul and posted publicly that this is his biggest nightmare as a broker. His words, not mine.
KOSPI
Why?
have been
Because of the
multiplying
margin
inside the
trading
Indian
facility
market over the
book.
last 4 years,
Zerodha alone
waiting for
carries
a
an
single
MTF
trigger
book
to
of
set
around
off a chain
9,000
reaction.
crore rupees,
To
which
understand if
Kamath
India's
called the
financial
biggest
system
risk
is
the firm
actually
has
at
taken
risk,
since it
we need to
started in
dissect
2010.
the structural flaw that broke the
Industry-wide,
Korean
MTF
market
has
and
crossed
see if Indian
1.2
retail
lakh crore
investors have
rupees.
built the exact
Brokers
same
now
trap.
offer MTF
The
on nearly
KOSPI crash was a
1,500
structural
stocks.
failure built on
And here is
two
the
highly
detail that should
volatile
genuinely
pillars:
worry you.
market
Roughly
concentration
half of
and
that
extreme
exposure
retail
sits in
leverage.
non-FNO
This
stocks,
pie chart of the
small
KOSPI
caps and
index
mid
shows
caps,
the scale of the
stocks
problem.
without deep
Driven
liquidity.
by the AI
You know
boom,
what happens
just
to an
two
Indian small
companies,
cap in a
Samsung
panic?
and SK
It hits the
Hynix,
lower
grew
circuit.
to consume
Trading effectively
52% of
stops
the
because
entire
there are no
index.
buyers at any
The health
price.
of the
Now
entire
imagine
market
you
became
bought that
tied
stock
to a
with
single
borrowed money.
semiconductor
You cannot
cycle.
sell. Your
At the same
broker cannot
time,
sell
retail
either.
investors
The
borrowed
debt keeps
heavily to chase
compounding while
tech
the
gains.
exit door is welded
Retail
shut.
margin debt, money
Borrowing to
borrowed
buy
from
illiquid
brokers,
stocks doesn't
swelled
just
to a
increase your
record
risk. It removes your
37.74
ability to
trillion
leave.
won.
India's
Many
MTF market
investors
has
also
grown up
used
entirely
single
in the
stock
last 3 to 4
leveraged
years.
ETFs,
It
which
has never
multiply
been
both
stress
gains
tested by
and
a sharp
losses.
correction. Not
Then the
once.
global AI narrative faltered.
4
Big tech
warnings
companies in
India
the
should take
US signaled
seriously.
a potential slowdown in
Warning 1.
spending, causing a
Guardrails
dip in
matter and ours have
semiconductor
helped.
stocks worldwide.
Korea's
When
finance
extreme
minister Koo
leverage meets
Yoon-chol
extreme
stood in parliament and
concentration, a
apologized for the
shift in
rollout
market
of single
sentiment is
stock leverage
mathematically
ETFs,
sufficient to
saying
trigger a
regulators
systemic
had not
shockwave.
thought through how they
This
would behave
diagram
after
shows the
launch.
anatomy of a margin cascade.
India does not permit
When
those
prices
products.
drop, the
Kamath
value of an
himself
investor's
credited
collateral
SEBI for
falls.
keeping the worst
Brokers
leverage
issue a
excesses
margin
out of
call,
our
and if
market.
the investor cannot pay,
Sometimes the
the
regulation
broker
you
must
complain
sell the
about
stock
is the
to cover
reason
the
your
debt.
portfolio still
That
exists.
forced selling drives the price down further,
Warning 2.
triggering the next wave of
Leverage is
margin
still
calls.
here, just wearing
This
different
cycle
clothes.
bypasses human
No leveraged
decision-making.
ETFs
It is
doesn't
an
mean no
automated,
leverage. We
self-reinforcing
have
freefall.
enormous FNO
This brings us
participation,
to
a
India.
fast-growing
Over the
MTF
last
book,
4
and a
years,
rising
the
habit
margin
of
trading
taking personal
funding,
loans
or
and credit to buy
MTF, book
equities.
has grown rapidly
The instrument
as millions
changes,
of
the
retail
mathematics
investors
does not.
began borrowing money to amplify their
Warning
trades.
3.
Zerodha alone
Concentration is a
holds an
personal
MTF
risk,
book of
not just
roughly
an index
9,000
risk.
crore rupees.
You don't need to run a
Crucially,
country's
at least
benchmark to
half
have
of
a
that
KOSPI
borrowed money
problem.
is parked in
If your
non-FNO
entire
stocks,
portfolio is
small
defense
and mid-cap
stocks or
companies
PSU
that lack the
banks or
liquidity
one
of
hot
major
theme,
blue chips.
you have
In
personally
India,
rebuilt the
when
Korean
small-cap
index
stocks drop
inside your own
sharply,
demat
they
account.
hit lower circuits. Price limits were
Warning
trading
4.
stops because there are
Good
no
earnings
buyers.
do not
If you
justify
have
any
borrowed money
price.
to buy these stocks,
Korea's
you are
chipmakers
trapped.
delivered.
Neither
Their
you
shareholders
nor your
still
broker
lost
can
badly.
sell to settle the
Great
debt.
company and great
Borrowing money
investment
to
are
buy
not the same
illiquid
sentence.
stocks removes your ability to exit a trade.
So where
The
does this
Korean
leave
crash
India?
proves that this
There are honest
combination is a
reasons for
setup for
optimism
forced
and honest reasons
liquidations.
for caution.
To avoid a
Let me
similar
give you
crisis,
both.
India must
The
heed 4
optimistic
warnings.
case. Our
Warning
index
1.
is genuinely
Regulatory
diversified.
guardrails are
Our
essential.
earnings are
While
distributed
South
across
Korean
banking,
investors
pharma,
amplified losses with
infrastructure, and
single-stock
consumption.
leveraged ETFs,
And as global
SEBI's
money
ban on these
exits
products has
overcrowded
protected
East Asian
Indian retail
semiconductor
accounts.
trades,
Warning
India
2.
becomes a natural
Leverage remains a
diversification
widespread
destination.
risk.
The
Indian
rotation we talked
participation in
about last
futures and
video works
options
in
and
our
the use
favor
of
here.
personal loans for stock
The
purchases
cautious
has reached
case.
a massive scale.
Foreign investors have
Borrowed
been
money
persistent net
accelerates
sellers of
losses
Indian
regardless
equities
of the
this year.
instrument used.
Our
Warning
sentiment
3.
is still hostage
Avoid
to crude,
portfolio
to global
concentration.
inflation, and to the
Relying
mood
on a
on the
single
Nasdaq.
sector creates a personal
And that
KOSPI risk.
untested
If
MTF
that
book
industry
is sitting
dips,
there.
your entire net worth
Is
is
the worst
vulnerable to
over
the
for
same
Korea?
downward pressure.
The bull
Warning
case
4.
says the most
Solid
violent
earnings do
forced
not
selling
justify
has
the wrong
flushed
price.
through and
In
valuations have
Korea, tech
reset.
companies posted
The
strong
bear
results,
case says
but their
leverage
stocks
takes
crashed
months,
because
not
investor
days, to fully clear a
expectations had
system.
detached from
Honestly,
financial
nobody
reality.
knows. Which is
Ignoring these
precisely
safety
why you
nets and the
manage risk in
basics of
advance rather than
diversification
in hindsight.
leaves investors exposed to severe
So here's
losses
the
when the
bottom
market
line.
cycle inevitably
The AI
turns.
companies driving global
Regarding the
markets
impact on
are by and
India,
large
there are reasons
profitable
for
and
optimism.
structurally sound.
South Korea's
But that is
index
not
is
what broke.
50% semiconductors,
What broke
while
was
India's IT
leverage,
sector is just
concentration,
8% of the
and
Nifty 50.
expectations detached from
India's earnings
arithmetic.
are widely distributed
Those three
across
things
banking,
together
pharma,
turned
and
an ordinary
infrastructure.
correction
As
into a
global
national
funds
crisis.
exit overcrowded East Asian trades,
Three
India is
golden rules to
positioned to
take
receive
away.
those flows.
1.
However, short-term
Never
risks
borrow to
remain.
buy illiquid
Foreign
stocks.
investors have
If you
pulled nearly
cannot exit,
2.6
you
lakh
do not
crore
own
out
an
of Indian
investment.
equities this
You
year
own
to
an
shore up
obligation.
capital. Local sentiment also remains
2.
tied to external pressures
Diversify
like
across
crude oil
sectors,
prices and
not
global
just across
inflation.
stock names.
Is the worst over?
15 stocks
The
in
bull
one
case
theme is
suggests the
one
most
bet,
aggressive
not
forced
15.
selling has ended, resetting
3.
valuations. The
Buy
bear case
businesses at a
argues
price
that it
that
takes
allows for
months for
imperfection.
massive retail leverage
Price
to
for
clear out of
perfection
the
means
system.
priced for
The underlying
disappointment.
AI companies driving global markets
Markets
are
correct.
profitable and
That is
structurally
normal,
sound.
healthy,
The
and
crash occurred
survivable.
because leverage,
Excessive
concentration,
leverage
and
is what
wild
turns a correction
expectations
into a
magnified
wipeout.
a standard market correction.
The investors who
Remember,
benefit
markets
most from the
correct,
next leg
but
of growth
excessive
are the
leverage
ones
destroys.
actively managing
The
their risk
investors
today,
who benefit
while
from the next
everything
period
still
of
looks
growth
fine.
are those who actively manage their
At
risk
Wright
today.
Research, risk management sits at the center of how we build every portfolio, precisely because of scenarios like this one. If you want to see how we think about position sizing and diversification, stay subscribed. If this video added value, hit like, subscribe, and tell me in the comments, have you ever used leverage in your portfolio and what did it teach you? All of us at Wright read all the comments. This video is purely for education purposes and not investment advice. Markets are subject to risk, and leverage products carry the risk of losses exceeding your capital. Please consult your advisor before investing. Invest smart, manage risk. See you in the next one.